I'm Bill Wilt of Assured Research. Thanks so much for joining this quick hit video where we'll focus on the economy and what it could mean for the economy going forward and what it could mean for property casualty insurers and the financial results. This is drawn from our May 2024 Assured Briefing. If you're a subscriber, thank you. If you're not, you find this content interesting, feel free to reach out. We'd be happy to start you on a trial. Now, while I switch over, let me just and share my screen. Let me just comment that I can only hit in this short video, can only hit on a few points from our from this specific note, which uses kind of the classic Goldilocks parable to look at what if the economy is just right, too hot, or too cold. So acknowledging there are nuances beyond what I can share here and different points of view. Again, feel free to reach out. Be happy to share the May briefing with you as part of a trial to our work. So if the economy is just right, economy, I think 2024 into 2025, property casualty insurers, broadly speaking, are expected to do well. Here's the consensus estimates and how that translates into returns on equity for a broad cross-section of publicly traded property casualty insurers. What we're showing here is the spread over the 10-year treasury over, well, really this century. And if you look over here on the right-hand side that I'm circling, spreads over treasuries expected to be 11 and a half points in 2024 and 2025. That really approaches, almost exceeds the peak of the earnings cycle in 2006, 2007 after the 9/11 era hard market. 06 and 07 also had the benefit of being light catastrophe years, following really tough cat years in 2004, 2005. So in a just right scenario, P&C insurers expected to do quite well. Thank you very much. Now, what if the economy gets really hot? Well, we make the point that if the economy really heats up as the jobs market, for instance, and inflation looks like it could be the case. We make the point that that should translate into the companies into which and the industries into which P&C insurers are selling their products, that those industries should do well. This is the current consensus outlook for the S&P 500 companies, organized here by sector. On the left sheet, we show their earnings margins, earnings before interest and tax as a percentage of sales. And then on the right, their sales growth. Green, improving, red, decelerating or not improving. And you see most industries there, their margins are expected to expand in 24, 25. Most industries, certainly in 25, are expected to see sales growth, sales acceleration. In 24, you have a few industries that may see slight deceleration. But the broader point is, if the economy heats up and you get more green here, it is certainly easier for insurers, knowing that they have to price for not only exposure growth, but economic inflation, which is hanging in the 3.5% to 4% range for liability insurance, plus social inflation. We make the point that that is easier to accomplish when the companies that you're selling your products to are also experiencing margin expansion and mid-single digit sales growth. What if the economy gets too cold? Well, in addition, there you would have the Fed lowering interest rates. That in turn could spur some economic activity, but certainly it would negatively impact the investment income that property casualty insurers enjoy and benefit from. But we may also make the point that price sensitivity could become a concern. Remembering in a too cold scenario, insurers still need to price for sticky economic inflation and social inflation. And yet, if you have, in that previous graph, more industries starting to show red with earnings margins getting worse and sales growth decelerating, you have some price sensitive customers. Now we know P&C insurers enjoy a relatively inelastic demand curve, but it's not zero. And so what we show here with data from Verisk's Market Stance business unit is the relationship between self-insured premiums and the value-added GDP by industry that you see there on the left. And the broad point is that you have some big industries that purchase lots of commercial premiums, transportation and warehousing, manufacturing, retail trade, down there at the bottom, healthcare, that have self-insurance off-ramps, so to speak, and alternative risk transfer programs that they can really ramp up, as though they haven't already, if the economy cools off and property casualty insurers need to continue raising prices. So our 2 cents is that P&C insurers should be just fine in economic scenarios that are either just right or a bit too hot, and the real risk comes if the economy cools more than is expected. The good news is that's also probably the least likely of those three scenarios. So as I sign off here, I'll just say thanks so much for your attention, your interest, and please do feel free to reach out if you'd like a trial to our work.